You budgeted $10,000 and spent $12,000. Good or bad news? The answer might surprise you. Today, we're analyzing variance analysis. By the end of this video, you'll be able to spot adverse variance and favorable variances and know exactly what they mean. Let's dive into it. Budgeting. Planning future activities by establishing performance targets, especially financial ones. Let's look at an income statement. In an income statement, you'll find incomes such as sales or income from services rendered or commissions received. We will also have gross profit, which is the difference between sales and cost of sales, which is also an income component. And we will have operating profit, which is after I deducted any operating expenses. I'm highlighting these green areas because they are income areas. And then we also have the profit for the year. Our expense components, cost of goods sold, purchases of materials that we're using, the purchases of inventory that we're using. We have other expenses or operating expenses, such as a few examples: selling expenses, salaries and wages, rent, expenses, utilities, etc. Variance analysis, calculation of the differences between budgets and actual figures and analysis of the reasons for such differences. A favorable variance, a change from the budget that leads to higher than planned profit. When my actual incomes are greater than my budgeted, for example, if my sales turns out to be 10,000 instead of the budgeted 8,000, we're very happy. When my actual expenses are less than my budgeted, for example, telephone actually ended up being 8,000 instead of the 9,000 that we budgeted, so we're happy. Adverse variance, a change from the budget that leads to lower than planned profit. If my actual incomes are smaller or less than the budgeted, for example, if my sales actually ended up being 6,000 instead of the budgeted 7,000, then I'm not that happy. If my actual expenses are greater or more than my budgeted, for example, if my wages ended up being $9,000 instead of the planned 7,500, then I'm not happy. Let's look at a question. I'll guide you through this. In this question, we want to find the variance, the difference, and we have to say if it's adverse or favorable. For revenue, the difference between the 165 and the 150,000 is a variance of 15,000. So this is adverse because my actual incomes are less than the budgeted. Let's look at the next one. Cost of materials, the difference between 80 and 70,000. The difference is 10. In this case, it's a favorable variance because my actual expenses ended up being less than what I was planning. Labor cost, the difference between 22 and 23. The variance is 1,000. In this case, it's adverse. So the actual expenses ended up being more than what I budgeted for. Gross profit, 63 versus 57,000. The variance is 6, which is adverse because my actual incomes ended up being less than my budgeted. Overheads, 40,000 versus 43,000. The variance is 3. In this case, it's adverse because my actual expenses ended up being more than what I budgeted for. Operating profit, 23,000 versus 14,000. The variance or the difference between the two is 9. And in this case, it's adverse because my actual incomes ended up being less than what I budgeted for. For those of you interested, I will be making these PowerPoint presentations available on my community. See the link in the description. YouTube believes you'd like this other video. Be sure to check it out as well. See you in the next one. Bye bye.